What if I told you that $10,000 invested today could become $100,000 in 30 years without adding a single extra dollar? What if I told you that the difference between someone who retires poor and someone who retires wealthy is often not how much they earn, but what they do with what they earn? In a study, researchers found that a person who invests $200 per month starting at age 25 ends up with more wealth than someone who invests $1,000 per month but starts at age 45. The secret is not the amount, it's time and understanding the basic rules. Stay with me as I explain everything you need to know about investing from zero in a simple and clear way. Imagine this scene. You're sitting with your friends and the conversation turns to investing. One friend talks about stocks he bought and profited from. Another talks about real estate. A third talks about cryptocurrencies. You sit quietly, not understanding half of what they're saying. It feels like they're speaking another language. In your head, questions pile up. Where do I start? How much money do I need? Won't I lose all my money? Don't I need to be an expert in economics? These fears and questions stop millions of people from ever starting to invest. Here's the truth you need to understand right now. Investing is not as complicated as it seems, and it's not only for the wealthy or financial experts. Anyone can start investing with small amounts and basic knowledge. In fact, simplicity often beats complexity in investing. The most successful investors use simple strategies that anyone can understand and apply. Let me explain everything from the beginning, clearly and simply. What is investing and why do you need it? Investing, simply put, is placing your money into something you expect to grow in value over time. Instead of leaving your money in a regular bank account where it loses value due to inflation, you put it into assets that can grow. Inflation is the silent enemy of your money. If inflation is 3% per year, your money in the bank loses 3% of its purchasing power every year. After 10 years, $10,000 will buy only what $7,400 buys today. You didn't lose the money, but you lost its value. Investing protects you from inflation and, more importantly, grows your wealth. Before you invest a single dollar, do these three things first. Pay off high-interest debt. If you have credit card debt with high interest, there is no investment in the world that can beat that. Pay off this debt first. It's the best investment you can make. Build an emergency fund. Before investing, save enough to cover 3 to 6 months of essential expenses in a safe, easily accessible account. Why? Because investments fluctuate. If you suddenly need cash, you might be forced to sell at a loss. An emergency fund protects you and allows your investments to grow without fear. Define your goals and time horizon. Why are you investing? Retirement in 30 years? Buying a house in 5 years? Paying for your children's education in 10 years? Your time horizon determines the right investment type. If you need the money in 1 to 2 years, stocks are not suitable because they're volatile in the short term. But if your horizon is 10 years or more, stocks are excellent because short-term ups and downs don't matter, and long-term performance has historically been strong. Main types of investments. 1. Stocks. Stocks are ownership shares in companies. When you buy a stock, you own a small part of that company. If the company grows, your stock value increases. Some companies also pay dividends. Historically, stocks provide the highest long-term returns, averaging 8 to 10% per year over decades. However, they are also the most volatile. In 1 year, stocks may rise 30% or fall 20%. That's why stocks are best for long-term investing. 2. Bonds. Bonds are loans you give to governments or companies. They pay you fixed interest and return your principal at maturity. Bonds are more stable than stocks, but offer lower returns, usually 3 to 5% per year. They're suitable for conservative investors or short to medium-term goals. 3. Real estate. You can buy property to live in or rent out.
Real estate provides rental income and potential price appreciation, but it requires significant capital, active management, and has low liquidity. You can't sell quickly if you need cash. 4. Commodities, gold and silver. These are mainly used as protection against inflation and crises. They don't produce income and don't grow much over the long term. Gold can be useful as a small part of a portfolio for safety, but not as a main investment. 5. Cryptocurrencies. Cryptocurrencies like Bitcoin are extremely volatile and high risk. They're not suitable for beginners or anyone who doesn't fully understand them. If you invest in crypto, it should be with a very small amount you're willing to lose completely. So where should a beginner start? The best advice for beginners is simplicity and diversification. Diversification is the golden rule of investing. Never put all your money into one stock, one sector, or one market. If one investment fails, another may rise, protecting you from total loss. The simple beginner strategy. Invest a fixed amount every month consistently and never stop no matter what happens. That's it. This simple strategy often outperforms complex strategies used by so-called experts who spend hours analyzing investments. Time, consistency, and discipline beat everything else.